Why are we saying that these stocks will explode in 2021? Well, 2021 will be a very different place to where we are now in 2020.
If you believe the impact from coronavirus will largely be over by then, and also that the final Brexit deal will have been resolved one way or the other, removing the unhelpful uncertainty, then there are a few stocks very well placed to skyrocket.
I've just bought into 3 of these stocks. In this video, we'll cover what I've bought, the price range I was aiming to buy in, and what it is that is so great about these companies. Let's check it out.
Welcome to unshackled.com, the investment and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe.
If you head over to the Money Unshackled offers page, linked to below, you'll find thousands of pounds worth of offers for investment platforms and services, including apps where you can not only buy these stocks, but they'll also give you a free stock just for signing up. Don't miss it.
Taking off. The first stock that I bought was Dart, the travel company that owns Jet2.
This stock, like the rest of the travel industry, has taken a hammering since the lockdown started. Jet2 is a huge business in the UK, and Dart stock is valued at about £1.2 billion, but before lockdown, its market cap was £3.5 billion.
I bought in recently when the share price was 667 pence. Since then, the price has been fluctuating a bit higher than this, between around 690 and 720, but I'd still buy it now. I believe this stock has a lot of ground to recover after COVID passes. At one point, this stock even went as low as 305 pence. This for a stock which was valued at 1900 pence before the crisis. Some wily investors will have already doubled their money. But that's in the past. Let's look forward to where this stock is going.
We've got to be careful here that we're not trying to catch a falling knife, but the fundamentals of the company are solid. For one, the other UK airlines are strapped for cash with loads of debt, while Jet2 is cash rich and is probably the least likely airline to die from COVID. It can easily survive the foreseeable future with reduced revenues now because of that cash buffer. Before COVID, its revenue increased massively in each of the last 5 years, and its earnings per share have been creeping up too, 2020 excluded of course.
We even saw massive annual dividend increases every year up until 2020, when it had to cut them when the travel industry was forced to close down. What's special about Dart is that they have no debt to worry about. Their net debt is negative at £189 million, meaning they have a big pile of cash which is bigger than their debt. This is now helping it to get through a difficult period.
Let's remind ourselves of what caused their current predicament. On a sunny March 23rd, Boris came on our tellies to tell us our liberties were being put on hold for 3 weeks. Fast forward several months and we're still banned from flying to many countries that Jet2 operates to, without being placed under a 2-week house arrest on arrival back home.
The government's flip-flopping on which countries can and can't be travelled to have caused the public to abandon all thought of foreign holidays in 2020. Why would anyone book a holiday to say Portugal or Cyprus, or indeed anywhere in Europe, when there's a chance that your holiday destination could be added to the government blacklist before you left? Or worse, while you are away.
Jet2 stopped flying for the first few weeks of the pandemic, but they are now flying again with a reduced flying programme. They're doing the best they can, while their own government does its best to inconvenience their customers. Whatever your views are on the COVID precautions taken, they have been disastrous for holidaymakers.
We feel the share price is reflecting more of the current situation than the long-term outlook. And the current situation is bleak, while the long-term prospects are fantastic. Let's not forget that now that their big competitor Thomas Cook has left the scene, when things get back to normality, there is a big gaping hole for Jet2 to fill. Just look at what happened here when Thomas Cook went bust. Jet2 have not yet had the time to capitalise on this. If we take some fairly cautious assumptions, like that people will be desperate to go on holiday again in 2021, then this stock has the potential to explode in a good way.
All it would take is for flight schedules to return to something close to normal, and this stock could easily return to its pre-COVID heights of 1900 pence. Even a fraction of that would still be awesome. It has loads of cash, a track record of expansion, great reputation, dominance of the UK to Europe flight corridors, and let's face it, as soon as Boris tells us that we're allowed to go on holiday again without the risk of house arrest, everyone who couldn't enjoy a break in 2020 will be rushing to book their flights for 2021.
Not dead yet. Next on the buy list is ITV. Yes, that's right, the clunky old TV network offering an obsolete product of scheduled broadcasted programming. As a concept, its product belongs in the dark ages alongside MySpace and Tamagotchi.
And yet, there is something too good to ignore about the ITV share price right now. Its 5-year chart is a story of decline, as its perceived future potential gradually declined to reach parity in 2019, with some estimates of what its underlying assets are worth, which some argue is around 130p a share.
But then 2020 hit, along with COVID-19, and ITV's revenue started to dry up. When a crisis happens, the first thing companies cut are their advertising budgets. And ITV makes its money through companies paying to advertise their products on its shows. The share price has taken a hammering down to where it is at now, 62 pence. Too low. I bought in at 60 pence.
Its debt is only 2.5 times operating profits, which is outside the danger zone. Anything above 3 would start raising concerns. And on August 27th, Goldman Sachs bought significant holdings in ITV, reflecting the bargain nature of the stock. A massive vote of confidence in an otherwise whirlwind of negativity surrounding the broadcaster.
We understand why many investors are downbeat about ITV. The model is dinosauric in its ancientness, and COVID has limited its ability to create fresh content and cash in from advertisers. And it's just been kicked out of the FTSE 100, as its market cap has fallen below the qualifying amount, which doesn't really affect the company if you think about it, but it is a huge psychological blow to be relegated out of an index.
The share price of a stock often falls when it is relegated out of an index. Big funds tracking the FTSE 100 would have had to sell ITV now, driving the price down further. Conversely, this means it could go back into the FTSE 100 and get an additional price boost in future. ITV's market cap is currently £2.5 billion, but its true value is hidden in its studios, its people, and its ownership of popular content. Experts place the value of these at around £5 billion if it were bought out.
It's easy to forget just how far the share price has fallen in the last year. At the start of January, ITV had a market cap of 6.4 billion, more in line with reality. Its share price has now plummeted well below what its underlying assets are probably worth.
Failing TV and media companies are bought up all the time by more successful ones. Entertainment One, owners of kids' favourite Peppa Pig, was taken over this year by Hasbro for £2.9 billion, which was 15 times annual cash profits.
ITV's cash profits now hover around the 500 to 600 million mark, and a 15 times markup would value the company at around £7.5 billion. We're not saying ITV has anything as genius and captivating as Peppa Pig, but its current share price is nowhere near this valuation. However you value this company, it looks like it's deep into bargain territory.
ITV is a big fish in an ever-decreasing pond. The onslaught of on-demand TV from Netflix to YouTube will one day mean ITV's current business model will be dead in the water. But that day isn't yet. On-demand streaming is for sure the most popular way of getting telly for our generation and the under-30s. But while we can all agree that broadcast TV is a dying medium, for people over 45 it's pretty much as popular as it has always been.
Total minutes per day of eyeballs on broadcast TV programmes fell from 242 in 2010 to 183 minutes in 2019. That's a decline of 24%. That's not dead. It's certainly not right to value the company at under half its probable underlying value, as the current share price is suggesting.
We've seen this before with tobacco and paper books. An industry is written off as dead, only to linger on for another few decades. Once COVID passes, filming will start up again, and advertisers wanting to sell products to the over 45s, to the age group with all the disposable cash, will once again pay to be on ITV.
My strategy for this stock is not to hold it long term. I plan to capitalise on it as it returns to something resembling sensible, hopefully doubling my money, and at that point I will sell. What I'm really hoping for is a buyout. If Netflix or Prime or some other company were to buy out ITV and strip it for parts, then its purchase price should be well above what its current market value is. Failing that, I'd hope that the price would rise back to parity once the economy settles back into a normal rhythm. ITV is going to die one day, unless it fundamentally adapts to a changing world. So once I've made some respectable gains, it will be sell, sell, sell.
Shot to success. The third stock is Stock Spirits, a UK company that sells vodkas and other spirits in Eastern Europe to mostly Poland and the Czech Republic. We would never have heard of this company except that it came up on a Stockopedia screener that we'd set up to fish for stocks with specific growth characteristics.
This is a stock with great fundamentals, a low PE ratio relative to its industry at 11.4, a growing earnings per share, a growing dividend with a 3.7% yield, low net debt being a 1-to-1 ratio against cash profit, and it's buying up other companies, including an expansion in Italy. It's a hidden gem with a market cap of just £451 million. That's just 11 times cash profits and doesn't factor in the great potential that I see for this company going forwards.
Even though Stock Spirits is a UK company selling spirits into Europe, the biggest challenge for Stock Spirits right now is not Brexit, but COVID. Brexit isn't a problem because all the production facilities are in Europe, only the head office is in the UK.
Lockdowns, however, have meant that the pubs and restaurants that would normally sell their products in Eastern Europe have been closed to the public, but it hasn't stopped them.
They had a first half earnings spike because everyone was hoarding essentials, which apparently in Poland includes vodka. They've also expanded their product line to produce hand sanitizer during COVID, and the world is now emerging from general lockdowns.
I bought into this stock at 221 pence. The price has only moved a little since time of filming, so it's still as good of a time to buy. My thinking with this stock is there is nothing holding it back. It has survived the worst that the world can throw at it, adapted, continued to expand, and kept its fundamental numbers tight over the years. Unlike ITV, I'd look to hold Stock Spirits in my portfolio longer term. It has a lot of growth potential, and there's no reason why this stock shouldn't explode in 2021 once the dust has settled from the madness of 2020.
You can research all the stocks we've covered today on free sites like ft.com and Morningstar, or you can join us on Stockopedia to get all the analytics tools we use. We've arranged a 25% discount off your first year for our viewers, plus a 14-day trial to try it out for free, link to below.
Question of the day: what stocks are you adding to your portfolios in advance of 2021? Let us know in the comments below.
Thanks for watching! On this channel we talk a lot about personal finance, investing and all things money, and if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.